A salesman in Boston invested about $4,500 in a company, forgot about it, and years later discovered it had grown into nearly $4 million. Of course, luck played a role, but the real luck wasn't forgetting the stock, it was picking the right business. Because if the business was weak, forgetting it wouldn't have created wealth. It could have destroyed it. That's the key point. Time alone doesn't build wealth. It only works when the business is strong enough to grow on its own. That's where Evergreen Stocks come into picture. These are businesses you can buy and hold for years, businesses that keep compounding even when you're not watching. And that's exactly what the video is about. We'll be breaking down 5 such evergreen companies built for long-term growth. But first, let's see how we filtered and identified these 5 stocks. So we kept the process very simple and created 5 clear and data-driven filters. First, growth consistency. Only companies that have grown their sales for more than 10 years and also continue to grow last year. This tells us the growth isn't from an old cycle, but is still happening. Next, 10-year average ROE above 15%. This tells us the business has consistently generated healthy profits for shareholders. Next, 10-year average ROCE above 15%. This ensures that the company is making good use of every rupee smartly. And lastly, market cap above 10,000 crores so that we can look at strong, stable companies, not risky penny stocks. After applying these 5 filters, we found the top 5 companies for you. Let's walk through each one of them to understand what these businesses do and what makes them on this list of evergreen stocks. Let's start with company number 5. Well, every time you drink a Pepsi, Tropicana or Mountain Dew, this company is making money. Varun Beverages. It is PepsiCo's largest bottler in India and the second largest globally outside the US. Let me tell you what that means. So Pepsi owns the brands, but Varun Beverages does the real work. It manufactures the drinks, bottles them, and distributes them across the country. In India alone, it operates across 26 states and 6 union territories and accounts for over 90% of PepsiCo's beverage sales in the country. But the real strength of this business is in the brand, its distribution. It has built a reach of over 3.8 million outlets, from small kirana stores to highways to big cities. On top of that, it has an exclusive franchisee with PepsiCo till 2039, which gives the business long-term visibility. The company has also shown strong execution. A good example is Sting, which today dominates India's energy drink category. As Varun Beverages has grown bigger, it has also become more profitable. Operating margins have gone up from about 19% in 2019 to around 24% by 2025. They sold more, they used their plants better, and they controlled costs more tightly. Management expects margins to stay broadly stable from here, supported by scale and sourcing discipline. But yes, there are risks. Regulations around sugar, water usage, plastic packaging can increase costs. Competition is also rising. Coca-Cola is priced aggressively and Coca-Cola is preparing a large IPO. The company is also expanding internationally with operations in South Africa, production in Congo, and entry into markets like Zimbabwe and Zambia, which is great. But it also adds exposure to currency and geopolitical risks. Still, at its core, this is a simple business. People keep consuming beverages, distribution keeps getting stronger, and scale keeps improving efficiency. Okay, now let's move on to company number 4, which comes from a completely different space, pharmaceuticals. When large global pharma companies need the core chemical ingredients for medicines, they often turn to Divi's Laboratories. Let's quickly analyze it. Divi's doesn't sell medicines to patients, it works behind the scenes. Its main job is to manufacture APIs, that's active pharmaceutical ingredients, which are the raw materials that make a drug work. What makes it special is how it manufactures. The company has spent years building very efficient in-house processes. It recovers and reuses over 90% of the solvents used in production, which keeps costs low and margins consistently high. Another big strength here is regulatory trust. Divi's has seen years of consistent approvals from the US FDA and European regulators. That matters because these are the most demanding markets in the world. In fact, about 87% of Divi's revenues comes from exports, with 71% coming from the US and Europe. The company also manufactures many key raw materials in-house, which reduces dependence on suppliers and gives better control over cost and quality. It also does a lot of custom manufacturing, making complex molecules tailored for specific customers. Once these kind of relationships are set up, they tend to last for years. That's why Divi's today supplies to 300 plus customers in across 70 plus countries. Of course, there are risks here too. High concentration, over 40% of revenue comes from its top 5 products and close to 50% comes from its top 5 customers. This means earnings can be sensitive to pricing changes, regulatory changes, or demand shifts. Second, this is a working capital heavy business with long inventory and collection cycles of around 230 days. But over the last 2 decades, Divi's has built a reputation for quality, reliability, and consistency. It's not a fast growing story every year, it's a business that quietly compounds. Alright, let's move on to company number 3. This comes from a very important part of the market, two-wheelers. We are talking about TVS Motors. Today it operates across commuter bikes, premium motorcycles, scooters, EV two-wheelers, three-wheelers and exports. Brands like Apache, Jupiter, Ntorq, Raider and iQube allow TVS to cover the market from mass to premium. One thing TVS has done consistently is invest in products. In FY25, the company spent over 1,000 crore on R&D. That's why you see frequent launches and upgrades across segments. This shows up clearly in EVs too. In calendar year 25, TVS sold 2.98 lakh electric two-wheelers, making it the largest EV two-wheeler player in India with a 23.35% market share led by the iQube. TVS is also seeing early traction in electric three-wheelers, which adds another growth leg over time. Exports are another important part of the story. In December 2025, TVS reported 40% year-on-year growth in exports, which helps balance domestic ups and downs. Looking ahead, TVS is prepared for the premium end as well. The planned launch of Norton motorcycles is aimed at building a global premium brand over time. But of course, there are risks. Competition in scooters and premium bikes is intense. EVs depend on supply chains, especially critical components like magnets. And expanding internationally obviously comes with execution risk. Overall, TVS stands out for balancing growth with discipline. Now let's move on to company number 2. This one comes from a very different space, defense. Bharat Electronics Limited or BEL. It is not a typical PSU, it sits at the core of India's defense ecosystem. The company works across the Army, Navy and Air Force and builds critical defense electronics. Think radars, missile systems, electronic warfare and communication systems. What's important here is how it operates. It's not just supplying parts, it acts as a system integrator. That means it helps design the system, integrates different components, tests them and support them over their entire life cycle. Once BEL is part of a defense program, it usually stays involved for many years. This creates long execution cycles and very high entry barriers. You can see this clearly in the order book. As of Q2 FY26, its order book stands at around 75,600 crore. That's roughly 3 years of work lined up. Another thing working in BEL's favor is policy support. India is spending more on defense made at home, and electronics is one of the biggest focus areas. Of course, there are risks. It depends heavily on government defense budgets. Large orders can get delayed due to approvals or trials, and being a PSU, decision-making can sometimes be slower. But structurally, BEL plays a very important role. It's deeply embedded in India's defense programs. It works on complex systems that are hard to replace. And once an order is secured, revenues tend to be sticky. That's why it is less of a short-term story and more of a long-term policy-backed business. Now let's move on to company number 1, which comes from a space every Indian household understands: consumption. The company is Titan Company, which is not just one business. It's actually multiple consumer businesses under one strong brand umbrella. The biggest part is jewelry. Through brands like Tanishq, Mia, Zoya and CaratLane, Titan is the largest organized jewelry player in India. This matters because jewelry in India is largely unorganized, and when it comes to buying gold, trust matters more than price. Even today, Titan holds about 8% share of the overall jewelry market, which is huge in such a fragmented industry. What strengthens the business further is reach. Titan operates over 3,300 stores across 430 plus towns with close to 5 million square feet of retail space. Beyond jewelry, Titan has built strong positions in other categories too. In watches, Titan is India's market leader with around 27% share in the analog watch segment. In eyewear, Titan Eye Plus is already the second largest organized player with more than 850 stores. These businesses may be smaller than jewelry, but they add stability and keep the brand present in everyday life. Titan has also been careful with expansion. It keeps entering new categories like fragrances, ethnic wear, and even lab-grown diamonds, but without stretching the balance sheet or chasing growth blindly. Of course, there are risks. Jewelry demand can be affected by gold prices, regulatory changes can impact the industry, and competition remains intense. But what keeps Titan evergreen is simple: strong brands, wide distribution, and presence in categories where trust takes years to build. So there you have it. 5 companies, 5 very different businesses, but one common thread. These are not stocks built for short-term excitement, these are businesses built to last. That's the real idea behind Evergreen Stocks. Also, we have created a sheet where you can find these 5 companies and their detailed metrics and pointers. We have linked it in the description and comments. As investors, we often underestimate patience and overestimate action. But over time, wealth is built not by doing more, but by owning better businesses and staying put. If you found this useful, let us know which company you'd like a deeper dive on. And if you want more content like this, simple, data-backed, and long-term focused, make sure you are subscribed. We'll see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.